Welcome to the deep dive. Today we're really getting into something crucial for building wealth: patience. Specifically, patience in long-term investing.
Yeah, it's a big one. And for this, we're drawing on some heavy hitters. John Bogle's Common Sense on Mutual Funds and the classic security analysis by Graham and Dodd.
Right. So our goal here is to unpack what these investing giants thought and figure out what investing for the long run, really letting patience pay off, means for you. Okay, maybe let's start with Bogle.
Sounds good. Bogle, his message is overwhelmingly about simplicity. He felt the financial world often makes things way too complicated.
And complicated usually means expensive, right?
Exactly.
Yeah.
He hammered on costs, called them a relentless foe. Things like, the expense ratios on funds he mentioned averages around 1%, maybe 100 basis points back then.
And that's not all, is it? There are trading costs, too.
Yep, transaction costs, commissions, market impact, all that stuff. He estimated maybe another 0.8% or so of the transaction value. Add it all up, and it's a real drag.
A drag that gets worse over time, which connects to his idea of the tyranny of compounding.
Precisely. It's the ugly flip side of compounding returns. Losing even 1% or 2% a year to costs doesn't just mean you have 1-2% less that year. It means you lose all the future growth on that lost money for decades.
So it snowballs negatively.
Massively. Compared to a low-cost approach, the difference in your final pot of money can be, well, huge.
So Bogle's answer is avoid all that. Focus on valuation, keep it simple, keep costs low.
Basically, yes. He famously said there's no secret to investing beyond a simple, low-cost, long-term plan. Often, achieved through something like index funds. Forget trying to time things or chase hot performance.
Okay, so that's Bogle. Simplicity, low costs, long-term indexing. Now, Graham and Dodd, where do they fit in?
Well, they provide the what. If Bogle's about how to invest cheaply and simply for the long run, Graham and Dodd are about what you should be investing in. They're the godfathers of value investing.
Right, focusing on the fundamentals,
Mm-hmm.
not the market hype.
Exactly. They stressed basing decisions on the performance of a corporation, its actual earnings, its assets, its prospects, not just the public's appraisal of the share prices, which can be, well, all over the place. Emotional.
So it requires digging in, doing the homework on the business itself.
Definitely. You need to understand the business, look at the financials, assess its intrinsic value, and this is key look for a margin of safety.
The margin of safety. Buying something for less than you think it's truly worth.
That's the idea. Like buying a dollar for 50 cents, as the saying goes. It gives you a cushion if you're wrong or if things don't pan out perfectly. It's about prudence. Owning a piece of a business you understand, not just speculating on price wiggles.
Okay, so when we put Bogle and Graham and Dodd together, what's the combined picture?
Well, they both strongly push you away from complexity, high activity, short-term thinking. All the stuff Bogle shows costs you money.
And Graham and Dodd give you the tools to figure out what solid businesses are worth owning for that long haul you're planning.
Right. So you use their fundamental analysis to pick sound investments, ideally with that margin of safety.
And then you use Bogle's principles to hold those investments simply, cheaply, patiently, letting the business value and compounding do their work over time without fees eating away at it.
Yeah, it frames patience differently. It's not just passive waiting. It's an active commitment, a commitment to businesses you've analyzed, that's Graham Dodd, held in a low-cost, simple way. That's Bogle. You let time work for you.
So the big takeaway seems pretty clear then. Long-term success really comes down to patience, keeping things simple, ruthlessly minimizing costs, and focusing on the underlying value, not just the noise.
Which leads to a really practical question for you listening right now.
Mhm.
In this world, we live in constant news flashes, easy trading apps, endless market chatter. How easy or maybe how hard did you find it to actually stick with that kind of patience and simplicity?
Yeah, something definitely worth thinking about for your own investment path.